All right, Treasury Department has labeled China a currency manipulator. So where does the U.S.-China relationship go from here? Erik Lundh is a senior economist with the Conference Board. He joins us now to discuss. So, Erik, I guess let's start with the official designation of currency manipulator, what it means, what it doesn't mean. In your view, watching this situation, was this kind of a formality? I mean, the president had said as much, but Treasury does have to designate it. And what tools do they have now?
Well, the president said, even during the campaign that he was going to do this. It took quite a while to get there, but he certainly has. By and large, the labeling of a currency as being manipulated is more of a formality than anything else. It doesn't trigger any sort of immediate response by the U.S. government. The Treasury is required to sort of negotiate with the offender to try to reach some sort of a free-floating currency relationship. But there's no automatic sort of tariffs or penalties that are implemented as a function of that.
So you've spent a lot of time in China and covered this widely. How do you feel about the two sides finding common ground? Have you ever felt worse?
It feels pretty bad. Yesterday was a bad day. You had, on the one hand, as I was mentioning during the break, the currency devaluation that took place, the designation of China as a currency manipulator, and then you have all these things that are happening in Hong Kong at the same time. So, there's a lot happening in and around China at the moment, and certainly the relationship between the U.S. and China. We keep on having these periods where there looks like there's some sort of potential for common ground and a settlement, and then we just dive right back down again. So I think at this point, maybe compared to the very beginning of the trade sort of dispute, when the original tariffs were implemented, it doesn't feel very good at the moment.
Well, let's talk about the Hong Kong part, because we so often just focus on the trade war, because that's the U.S. versus China piece. I think for U.S. investors, for our audience, easier to understand. But when you look at the Hong Kong protests right now, just politically, how much is that weighing on, what Beijing can or can't do when it comes to trade? What does it mean for their relationship with the EU? Or are they kind of separate issues? Because we've heard mostly that they're separate, but it does seem to me like, there's two big events going on in China. I'd be surprised if they were unrelated, right?
Well, they're separate until they're not, right? And so, there's been a lot of rumors flying around about, the PLA, the Chinese military getting involved in terms of sending troops across the border into Hong Kong to help maintain stability, and what that could potentially do in terms of international reactions and things like that. For the most part, the European Union has really sort of stayed away from this U.S.-China trade conflict. But I think, were there to be a heavy-handed reaction on the part of Beijing in Hong Kong, we may see the EU get off of the sidelines and maybe become a little more aggressive, not just on the human rights issues, but this could spill over into trade as well, because the European Union has their own issues with China with respect to trade.
So on the currency front, we've heard that the PBOC is very skilled, much more skilled possibly than the United States, just because they're used to working with their currency in this way. So what are some of the other ways that Beijing could try and fight the tariffs here? Like, do you see, people have talked about them selling treasuries or telling consumers in China not to buy Starbucks. Do you see either of those options on the table or possible?
I think with the Treasury sort of scenario, people have kind of been thinking about this a lot for a very long time, and the general consensus is among most economists that this would really be China shooting itself in the foot. By dumping a bunch of the Treasuries, it essentially, diminishes the value of what it continues to hold. The U.S. is also, one of China's primary export markets, so damaging the U.S. economy hurts their own exporters. So that's a pretty low. That's a nuclear option, perhaps. With respect to the other scenario with regard to boycotts on U.S. goods and things like that, China is doing the best, is really trying to maintain a friendly foreign direct investment environment. And so to go after individual U.S. companies or make them feel less welcome could inhibit their ability to attract new and retain existing capital, especially as the story with global value chain disruption is sort of falling out of the implementation of these tariffs. Foreign companies are thinking about other production locations in Southeast Asia and South Asia, places like that. That's a huge one that people talk about a lot. So making U.S. companies and foreign companies feel unwelcome in China even further sort of motivates them to look at other places to produce their goods.
All right, Erik Lundh, senior economist at the Conference Board. Thanks so much for joining us.
My pleasure.